Hey guys, it's Tanner Manson from Future Investing, and today I want to talk to you guys about the main stocks that I'm going to be picking up in April of 2021. Now, many of you guys may already know, but although I am actually a licensed financial security advisor as my full-time job, none of these stocks or topics that we talk about today are in any way my recommendation. This is merely my opinion, and you can choose to do what you wish with this information. Now, before we jump into it, if you could, hit the like button on the video down below and subscribe if you want to see more content like this. Now, let's jump right into it. I can't wait. Now, for stock number one on this list, I want to talk to you guys about goeasy Ltd, ticker symbol GSY on the TSX. Now, this is one of the smallest companies that I follow in terms of market cap at around $2 billion. Although that being said, this is an insanely interesting company and you have to hear me out. goeasy actually breaks into two separate segments. There's Easy Financial and Easy Homes. Now, for the sake of just the time on this video, we're only going to be talking about one segment, Easy Financial, because Easy Homes is like a lease-to-own type business where they lend out furniture and electronics, computers, these sorts of things, and have people pay them back slowly with interest on top of it. That being said, it's a smaller part of their business, and it's not as good as Easy Financial. It needs more manpower. It's not as automated, and there's a lot of like inventory and problems like that. So I actually think they're going to be getting away from that segment. But anyway, for the sake of this video, we are going to be talking about Easy Financial. Easy Financial is a subprime lender for people in short-term needs of cash. Maybe they can't get it from the bank or something along these lines, but they need a little bit of influx of cash for probably, bill payments, or maybe they have an auto repair, or maybe a house repair, some sort of emergency fund that came up that they weren't prepared for. And they can lend out these loans either online, which makes up 51% of their business, or at one of their retail stores, for which they have 400 locations around Canada. Now, interestingly enough, there has been so much interest in this company because people thought that they were going to have a really hard time during the pandemic. Now, with all the lost jobs during the pandemic, investors were worried that goeasy was not going to get their money back from all these loans because, well, people just aren't going to have the money to do so. But that was the complete opposite of what actually happened. They had an insurance provider cover in case of loss of jobs, and so their delinquency rates has actually dropped. Their delinquency rates on their payments are only 4.3% in this segment. Whenever you have extra high interest rates, usually the delinquency rates to supplement that would be extra high, somewhere along the lines of an average of 21%. But yet, Easy Financials was only 4.3%. And so with all that information combined, the stock had actually returned up to 500% since the pandemic had started back in March of 2020. And the actual business itself has been growing like crazy. Like their loan portfolio aside, like where they divvy out their loans, has grown 35% compounded annual growth rates year over year since 2016. Like that is, I say this every single time I talk about this video, but it is the most insane statistic ever. You don't see a lot of tech companies bringing out compounded annual growth rates of that rate, and yet here we have a small financial company that is lending out the most insane rates. And with that loan portfolio growing so quickly, the interest rates, because they're subprime, because they're non-prime customers, the loans are insane interest rates, anywhere between 25 and 40%. Now, I'm not saying I would get a loan from there. I've got a fine credit score. But whenever it comes to them being a company that I could possibly invest in, I cannot ignore the growth and how fast this company is taking advantage of, their type of payment system. We have 43 consecutive quarters of same-store sales growth. We have 78 consecutive quarters of positive net income. This year will be the 17th consecutive year of paying dividends and the 7th consecutive year of continuous dividend growth, which actually, just speaking on the dividend, actually is leading to a forward dividend of around 2%, and yet the payout ratio is only 20% of their business. I want to actually test something in the comments down below. I want you guys to type me a company, some sort of company that actually has anywhere close to the numbers that this company is putting out. And I'm not talking about some crazy tech companies that are in massive income losses. I'm talking about a positive net income sort of company that lays out this type of growth. We have profit margins of close to 30%, operating margins of close to 35%. And on that, you think that the stock would be priced through the roof, but there's a forward PE ratio on this stock of 12 times. That's lower than the actual stock market average of around 15 times on good years, let alone in 2021, whenever that is spiked up to like 35 times. And I'm offering you guys a company here for 12 times PE ratio with this this type of growth. Let's quickly continue though, because the numbers aren't done. Let's also add in quarterly revenue growth year over year of 23.9%. Now that's revenue, right? That's how much that they're getting. That's not including how much they actually take away after paying all expenses. That would be their earnings. So their quarterly earnings growth is 66.8% year over year. So not only are they increasing their revenue like crazy, but they're actually finding out ways to keep more of their dollar per revenue to keep for themselves, which obviously, evidently, being an investor would help us as the shareholder, because the more that we can keep for ourselves, the more they pay out for dividends, the higher the stock goes, everything along those lines. I don't even know why this stock is only trading at a 12 times forward P ratio. Like, I mean, I think maybe it has to do with them being a subprime lender and just people just don't want to sort of deal with a company like that. The way I see Go Easy is that they're going to take this approach of sort of trying to build their foundation on subprime lending, but they're getting secured loan portfolios, for example, allowing to give out money backed up by real estate and with lower interest rates. Like, they're getting into less risky sorts of environments, and now they're going to be doing auto loans soon. They said that's their sort of next product that they've sort of, put their eyes towards. And I think as they get bigger and bigger, what will this company look at a $10 billion sort of market cap? Like, what sort of products will they be dealing with? Maybe they can get into the actual prime lending market and become a regular financial institution like the rest, but yet us as investors can get in at the ground floor when things are a little rocky and scary to be in. But that's exactly how to become a good investor, is that you have to bet against the consensus and be right every time. And I think that's what we're doing here with Go Easy. Now, quickly on to stock number 2, we have Salesforce, ticker symbol CRM. I actually just made a full review on this stock just last week. You could check it out over here, or I'll leave a link in the description down below that you can go check out. I've been really loving Salesforce lately, and it has a lot to do with the acquisition of Slack and how they're sort of getting into the social enterprise aspect of their company. Salesforce has actually almost dominated every single aspect of the CRM space, except for the social aspect. They tried a thing called Chatter, Salesforce Chatter, didn't really work, no one used it, and so now I think with this acquisition, a $27.7 billion software acquisition, one of the biggest in history, that they are going to give their Salesforce clientele another reason to use their software for a one-stop shop for everything. Because now, before, you'd have to do your business on, their CRM platform and then talk with your team on Slack or something along those lines, 2 separate softwares. Now, because of this acquisition, it's going to be all in one, including all that data, everything that, Slack had going for it, that growing business, and they took it on, gave them an offer they couldn't refuse, and we all know that Slack's going to grow from here. Now, Salesforce is at a $200 billion market cap. And a lot of their growth, similar to what they did with Slack, had to do with acquisitions. It's actually what a lot of these super, ultra mega cap companies have to do, because although there is organic growth and everything like that, sometimes there's, new tech or a new small company that comes into the business that, if a FANG stock like Apple, Amazon, Netflix or Google, that sort of space, doesn't consume that competitor, that they would be risk of, actually attacking their core marketplace, their core clientele. So then they give them, these crazy acquisition like offers to buy up their company that they just can't refuse because they're cash cows. And Salesforce is in that same boat. And you know who loves these types of companies? These ones that buy up everything and almost create a little bit of a monopoly, but that's what you want to see, right? You want a moat around your business. Warren Buffett always talks about that, castles, moats, and lords. Like the moat aspect of the business is the most important part in tech. And Salesforce has that. And smart money sees it. 83.5% of the shares that are held in this stock are held by institutions, smart money, hedge fund managers, these types of things. You want to be where smart money is. And I don't mean in shorting GameStop sort of thing, but whenever they pick out stocks, like the reason why Facebook is being held so much, Google or Shopify or any of these, this was huge institutional plays for a long time. Because they see the fundamentals and the sort of hype behind it. There still is a profit margin of around 19% on this stock. They're cash heavy, $12 billion in cash, only $6 billion in debt, even though that's after their acquisition of Slack that costed them $27.7 billion. Now, just going back to the castles, moats, and lords sort of thing, obviously the castle is their economic castle, which, what business isn't going to need a CRM? Like that is so important if you are in any of their sort of, spaces that they try to cover, service, healthcare, sales, anything along these lines, you need a CRM if you're in any of those industries. And so Salesforce is always going to have that economic sort of castle there. The moat is that no one can sort of do what Salesforce technology does because they have all these sort of patents and acquisitions that they've done over the past, 11 years or so that's made them the software that they are today. I actually personally use it with my business, and it's the best software I've ever had for like helping my clientele. That being said, the reason why I brought it up is the Lord, the CEO, Mark Benioff. This man is a monster, a titan of business. And if you haven't, researched about him or done anything to look up who Mark Benioff is, please do yourself a favor, Google his name. He is a very, very well-educated, smart businessman. I don't know, with those three things, with the Warren Buffett principles around it, while still being, a little expensive, a PE ratio of around 50 times, that's the only thing that I kind of can't wrap my head around, just being that sort of fundamental investor in that regard. It's pretty expensive, but just knowing where that company is going to go, it's almost like cash, in my opinion. It's inflation proof. If anything were to happen, I'd rather my money in Salesforce. It's an amazing tech company. I see it going to $1 trillion. I also see them offering a dividend in the future. I mean, why wouldn't they? They're just cash cows. And it'll bring more hype to their stock. But anyway, that's my pick for number 2. Let's jump on to stock number 3. Okay, now last but certainly not least, we have Enbridge, ticker symbol ENB. Now, this is a gas transportation company, okay? They deal with a lot of the crude oil and liquid gas transportation that happens in all of North America. Around 25% of all the crude oil that's produced here in Canada and the United States goes through Enbridge pipelines. So yes, they're an absolute massive company, around $92 billion market cap. But there are two schools of thought here. One is that people are investing because they know that oil is not going anywhere, and although there is a transfer to green energy, it's not going to happen as quick as some investors like Kathy Wood that I spoke about in my last video are going to be. It's not going to happen that quickly. There's no infrastructure for all this. Yet that all being said, Joe Biden is pushing as hard as he can to cancel some of the pipelines, even ones going on in Michigan now, Line 5, but with a forward PE ratio of 15 times. A dividend that hovers around 7 to 8% and a stock that grows around 7% a year, okay? The dividend grows 11% per year. They're only paying out a 66% payout ratio. I know I'm just dumping numbers. Maybe I'll write them somewhere on the screen, but it's incredible. It would be incredible to ignore an opportunity like this when oil is getting hit so hard. The stock has dropped so much, and the pandemic has given you an opportunity to get into such, a hedge against this sort of growth pandemic sort of thing. Like if a crash does happen, Enbridge will be a safe place because they lead, one of the most popular commodities in the entire world. And who else likes oil very, very much? Warren Buffett. Because even in 2021, his biggest purchases have been Chevron and Suncor and a lot of these oil companies because they're on massive discounts. He understands that this is a massive value play because people are putting, too much discount on oil. Yes, green energy is coming. And even Enbridge knows it. Like they are putting a lot of their new growth because they're just super cash heavy into green energy. So they're not silly in missing the opportunity here. But it's not coming tomorrow like some people would make it out to be that we're all going to switch over to electric cars within the next year. My car works fine. It's going to run me for the next 6 years. I'm not switching over anytime soon, and I'm not the only one. And honestly, with a dividend of the size of Enbridge's, I can truly see someone like Warren Buffett placing his position in a company like this. With the discount of the company that it has, he would want a company like this to bring such a dividend for Berkshire Hathaway. And that being said, I'd rather be in on this company on the ground floor before he places a position into it. Because the dividend right now of 7-8%, although it is high, it is, there's still tons of room to grow. Management in this company is amazing, and they know that the reason why people invest in this company is through their dividend. And so they've increased it around 11% compounded annual growth rates on their dividend for the last 26 years. Like, just think about that for a second. That is insane. So the earlier you can get in and, start building a position before they increase the dividends, the better off you are. And the price of oil is returning back to normal faster than ever. So they took this massive dip whenever oil, went into negative territories, and they thought, how's Enbridge going to even make a profit here? But then people realized that they're not actually connected to oil in that sort of regard. Like they're charging the companies. They don't care what the price of oil is. It's just how much they move. And so their actual profits didn't really change at all. And people are going, oh my gosh. So the price had dropped a ton and now is starting to recover very quickly because people are realizing that, yeah, we just gave up on a dividend and they didn't lose a thing. It's a very interesting company. And with that sort of low PE ratio, it might be something to look into. This stock could be a very great choice in 2021 if we start to have a slower sort of market where people are getting away from growth companies and looking more towards blue chip value investing sort of stocks, which in my opinion would be that sort of Enbridge type company where I can accept that dividend plus the growth on top of that because the business is always getting better and better and stay inflation proof as I sort of rather have this company rather than cash, and then sell out whenever I see a better price in the actual growth companies that I want to acquire. My end goal is to have another position in Tesla and in Shopify and these sorts of companies, but at the prices right now, I just can't justify it. So I'd rather sit in, cash or sort of a waiting sort of strategy like that. But why hold on to cash, which can be, subject to these sorts of, inflation risks and everything like that, and instead put it into a company that's going to pay you to hold it. And yet it's been so stable, not even just stable, but growing. In my eyes, it seems, clear and obvious, and I can wait for a better time for growth. But that's just me. And all this is just one man's opinion. Like I said, in no way is this a recommendation. Tell me what you guys think in the comments down below. I'd love to hear your opinions on my 3 stocks. Maybe there's other ones that you guys think I should be talking about instead. If you could, leave them in the comments down below. And also, it would be really appreciated by me if you could hit the like on this video and subscribe down below if you want to see more content. I got tons of videos planned coming out in the short future, and I've been keeping up this sort of schedule if I can for Tuesday mainly and Friday. Try to do 2 videos a week while I still try to grow my own, business on the other hand. And, if YouTube starts to take off and it goes faster than I think, I'll post more videos. But until then, I've got a select amount of videos that I want to put out and some interesting topics. And if things change in the markets, then I'll talk about those. But that's the awesome thing about the markets right now. They move so quick and there's so much to talk about. It's ever evolving and I'm just having a lot of fun. This YouTube stuff is a lot of fun, and I'm glad you guys are watching. It's been a blast. But anyways, guys, I hope you guys enjoyed the video, and until next time, see you later.